Hello, everybody. This is Jerry Lynch, and today we're going to talk a little bit about bonds, what we see happening in the market, and how it's going to have an impact on you. Again, we've been doing this for quite some time. I want to talk a little bit about a few different things. Number one, what are some of the fundamentals associated with bonds? How do these work for you? What are the drivers of returns? What's going to give us a positive rate of return on these? And how can this help with a portfolio? So a couple of things dealing with the fundamentals. In simplest terms, a bond is a glorified IOU. It's somebody like a lender saying, I have excess money. I'm willing to give it to you for a period of time. And for that, you're going to give me an interest rate. And the things that are really going to determine that interest rates are really two main things. Number one, the duration that you're going to be lending that person that money for or that institution, and the quality of that person having the ability to pay you back. So if you have a longer duration, generally you're going to get more money. If you're going to have a higher risk person, you're going to get more money as well too. But it's a lender and a borrower who agree to give money for a very specific period of time. The main people who issue these are government. You could have things like treasuries. There's a bunch of different agencies that do it, such as Fannie Mae and Freddie Mac, to help run the government. You also have corporate bonds. A company like Pepsi-Cola wants to expand. They want to buy trucks. They want to set up new buildings. They'll go to the market and they'll borrow money for a specific period of time to fund these operations. And then you also have a lot of municipalities where you live right now, where if they need a new sewer system, they need a school system, they want to do some of the roads, they'll use municipal bonds to fund it. And each one of these has their advantages and disadvantages. Now, who buys this? First of all, one of the biggest purchasers of bonds are insurance companies. They fund them based on when they have obligations coming in. So let's say a life insurance company will know that in the year 2025, out of their population, 1,000 people may die and they'll have claims of $10 million. So they'll have bonds that renew that year for $10 million to fund that obligation. Pension funds very similar is that they'll hold bonds knowing that next year they'll have obligations of $1 billion they have to pay out to different pension people that are participating in the pension program. So they'll have bonds renewing that year that become liquid, so they have the ability to pay out these obligations. And then you also have individuals that will buy these things either as part of their portfolio to give some stability, or they use it as a way to get income, especially if they're retired. But all three of these are examples of who is buying these on a regular basis. Now, the basics of bonds are that you have a principal amount, which is what the original purchaser bought that bond for. Most of the time, they're trading at about $1,000 a share. You have a coupon rate, which is what that issuer is saying that that is going to be the amount of interest that's being charged over that period of time. And then you have the yield. The yield's going to be determined on what the value of that bond is over that period of time. So using very basic terms, I buy a bond for $1,000. It's got a coupon rate of 5%, meaning that $1,000 is on the table, what I paid. $50 a year is going to come out in terms of interest. And then at the end, I'm going to get my $1,000 back. Now, one of the things that impacts the yield really for the secondary user is what if bond prices, if rates rise or drop. So if rates are rising, interest rates are rising, bond prices come down. That's what we saw 2 years ago as the Fed was raising rates to try to slow inflation in the market. If interest rates are coming down, which is what we're seeing right now, bond prices will go up. So that's one of the ways that that changes the yield on some of these bonds. So this is an example of what we're seeing right now. Let's assume I bought that bond with a 5% coupon. Initially, it was giving me a 5% yield. But now interest rates have dropped to 3%. So if I were to buy that same bond today from that same issuer today, they would only be giving me a 3% interest rate. It means that the bond that I bought previously would sell at a premium. And that bond, if it was a 4-year note, would basically trade at $1,020. So you got an additional gain on that because now your bond is becoming more valuable. On the opposite side, if interest rates go from 5% to 7, that would mean that you would have to sell your bond at a discount. So if somebody bought that bond at $9.50, their new rate, the yield, would be basically equivalent to what we're seeing right now in the street. So again, the interest rate changes is going to have an impact on your bonds, and that's something to be considerate about. So the risks that you have in bonds, there's really three major risks. Number one is the inflation risk. So 2 years ago, we had inflation at about an 8% rate, meaning that if I had a bond paying 3% and inflation is 8, I'm guaranteed to lose 5% of my money by being in that bond. So that's one of the risks that you have there. The second thing that we were just going through is changes in interest rates because that will change the value of your bond. If interest rates are declining, your bonds become more valuable. If interest rates are rising, it becomes less valuable. You'll have to sell it at a discount. And there's also a risk on an IOU of somebody saying, I can't pay you back. So these are the three major issues that you have with bonds. So the credit quality is very important. The stability of the rates. If the rates are going down, it's a very good time to be going into bonds. Now, understanding duration, that's the length that you have. The longer the duration of a bond, how long that IOU goes out is going to have a very big impact on fluctuations if there's changes in interest rates. So if the interest rates change by 1 percentage point and I have a 3-year duration bond, it's going to increase the value of my bond by 3%. So the general rule is for every 1% decrease in rates, I will get a 1% increase multiplied by the amount of years that I'm going out. So if I have a 7-year bond and the rates drop by 1 percentage point, I now have a 7% increase. If I have a 10-year bond, that same 1% drop will increase my value of my bond by 10 percentage points. That's what we're seeing right now with the drop in the interest rates. So I think it's a very good time to be considering these options. Now, what about the quality of the bond? We spoke a little bit about that. And generally, the highest quality bond would be U.S. Treasuries, backed by the full faith of the United States government. They could print up dollars and just give it back to us. So it's considered the best risk that's out there. You have agency bonds, which are government agencies such as Fannie Mae, Freddie Mac, paying for things like, school loans, mortgages, whatever the case may be. They still are backed by the government, but they're considered a little bit higher risk than treasuries. Muni bonds are considered kind of in the middle, backed by the financial ability either for the project to fund itself or by the town. They seem very stable. Corporate bonds, I feel very comfortable with a lot of corporate bonds. I feel if I bought a bond from Apple or Pepsi or a lot of these big companies that are out there, I'm pretty sure I'm going to get paid, but they can't pay me back in Pepsi dollars or Google dollars. So there's a bigger risk there. And then you have high yield bonds. So as you go up this spectrum, in theory, the rate that you have to pay for these people if you're buying these types of bonds, you should be getting a higher rate as you go from the left to the right. So high yield bonds should be paying the highest percentage. The way that we determine that is through credit agencies. It'll take a look at the financial stability, the ability for them to pay back. And some of the companies that are out there, S&P, which you might have heard of, Moody's, Fitch is another rating company as well too. And they'll usually rate them as AAA, AA, A, triple B, whatever the case may be. As you go from left to right, it means that it's a worse risk. So on the far left, it's a good quality risk. As you go from left to right, you're going into a level of risk that you have to make sure you want it to be in. All right, so what are the drivers of return in the bond market? First, and the Fed is really one of the biggest influences of what we're seeing out there. Number one is raising and lowering the rates, which is what they've been doing. They were raising it in order to slow down the economy and stop inflation. Now what they're trying to do is lower the rates to get the economy moving a little bit more. So it's like a gas pedal and a brake. When they raise the rates, it's basically putting on a brake. When they lower the rates, it's hitting the gas pedal. Secondly, the way they do it is by buying or selling government bonds. When they're buying, they're putting more cash out into the economy. When they're selling, they're basically getting more money back. So that's having an influence on it. And also what they're saying they're going to do going forward. So one of the last Fed meetings, they reduced the rate by 0.5 percentage point, and they gave guidance saying reasonably we may reduce the rate 1 or 2 more times this year. The percentages we don't know. So as the market sees that, they're going to say, all right, reasonably the rates are going to be going down. So we need to be pricing our loan packages in a very similar format. So how do bonds help a portfolio? First and foremost, income. If I take a look at most of the retirees we work with, most of them don't want to be in the stock market. The only thing they want to do is have a check come into their mailbox once a month. And when interest rates went down to zero for literally the past 15 months, it forced them into riskier assets of the stock market. So with rates being higher right now, it could provide stable, predictable income, especially for people that are retired. Number two, you get preservation of capital. If I hold my bond to maturity, I get my principal back. So it makes it a very stable type of thing to do. And then number three is I get diversification. It's working differently than the stock market. Very rarely do the stock market and the bond market work the same. When the stock market is generally volatile, bonds become more attractive. When the stock market's doing well, bonds have a tendency not to look as well. But it offers a level of diversification, which is nice. And where we see this in products that individuals like us buy would be number one in CDs. And CDs are generally shorter duration, lock in a rate for a period of time. I hold it from now until the period of time is over. I get my principal back and I get a little bit of interest. There's individual bonds. And what I like about individual bonds is that I can get out of it if I want to. But if I hold it from point A to when it redeems itself, I get my principal back guaranteed. I get that yield guaranteed during that period of time, and it's pretty stable. Now, the only negative thing is that if I'm buying a bond for $1,000, let's just say, and maybe I'm buying more than one bond, I'm in a very concentrated position. So then there's bond funds and exchange traded funds where that same $1,000 that I was used to buy only one individual bond, I could have 100 different bonds in my one portfolio. So these are ways that I could get access to different types of bonds that maybe include short duration, corporate, government bonds, whatever the case may be. I could get exposure in areas that are pretty good and kind of diversify my portfolio. And then there's separately managed programs where, let's say, a company like we use, PIMCO, could go out and buy us individual bonds and manage them in a very specific style. And I think these are very interesting, specifically at this moment in time, because I like the rates on treasuries, I like the rates on munis, but these are very complicated markets. And I like going to somebody who gets institutional pricing, which could save us some money and get us some diversification and access to some programs that we wouldn't have access to. So two different types of strategies that we have if you're owning individual bonds is one is buy and hold. I buy a bond today, I hold it to the maturity. I paid $1,000 when I bought it. I get $1,000 back at the end. And during that period of time, I'm getting that coupon rate every year, maybe once or twice, depending on how often they're paying. Very stable, very predictable. And I know when it comes up, I get my money back. The other way that you could do it is called the laddered bond strategy, where I buy bonds in this example over a 5-year period of time. And let's just use, I put in 100 grand, 20,000 each year is kind of renewing. I have 20,000 in each year. Each year I have an option to say, well, this bond is renewing. I get my $20,000 back. Do I need this from a cash flow standpoint? The answer is yes. Great. I take it. I spend it. If I don't, I could invest it back another 5 years. So I almost think about this as like the wheels on a Caterpillar truck where they just keep revolving. Each year I have an opportunity to say, I want to use it to buy more bonds. I need it for my cash flow, right? If I could even see, if I see that the stock market is better, I have the ability to shift it out. Now, during this period of time, I still have the ability to get out of these because they are liquid and they're publicly traded. But I just think that conceptually, when I'm working with a retiree, these are the types of strategies that we're going to work with a lot. So again, just to recap, the global bond market is large. It's larger than the stock market and offers a wide range of opportunities to be investing in. The yield to maturity, when I'm buying an individual bond, the thing I'm really focused on is if I buy this today and I hold it to maturity, what is the yield that I'm going to get from point A to point B? And I could use that to guarantee that a part of my portfolio is getting these reasonable rates of return. Short-term yields are generally dictated by the Fed. Longer term are going to be dictated by more market conditions. And credit risk is generally is determined by companies like Fitch, Standard and Poor's, a couple other firms that are out there. But the higher the risk of the borrower, the higher the rate that they're going to have to pay. And bonds can preserve principal, provide income, diversify your portfolio, add some things that you're not going to get in the stock market. And professional investment managers can offer a cost-effective solution in very specific situations, if that makes sense for you. Again, I think as we go into our review, I think all of us should be talking a little bit about this depending on where you are in your career. If you're retired, this is definitely a very good option. If you're getting close, same thing. I think there's some opportunities that are out here. Once again, thanks again for your time. Appreciate sharing some ideas with you. Any questions, please let us know. Always a pleasure to work with you. Thank you.